Have you ever wondered why is yen considered a safe haven even when Japan's economy has been deteriorating for the past decade? To begin, let's quickly look at this chart to illustrate yen's safe haven status. The blue line represents yen US dollar currency pair, while the red line represents iShare Global 100 ETF. From a glance, we can easily see the inverse correlation between yen and a risky asset like iShare Global 100 ETF. This means that whenever the world is facing uncertainty, the price of risky asset goes down while the price of yen goes up. Regardless of whether it is a US-China trade war, unfolding of Brexit, Trump's impeachment, or a global recession, in any times of uncertainty, we always see an appreciation in yen's currency value. However, by looking at Japan's economy, it has always been struggling for growth for the past decade. On quite many occasions, it was even shrinking. The effect of Japan's lost decade has been well established. In this period from 1991 to 2001, Japan has experienced a period of economic stagnation and price deflation caused by an environment of rising rates that sets a liquidity trap as a credit crunch was unfolding. While the Japanese economy outgrew this period, it did so at a much slower pace than other industrialized nations, and from then on, Japan policymakers continued to grapple with its consequences. So, it begs the question, why do people still buy yen during periods of distress then? The first reason that can explain this is yen's low interest rate and its use for carry trade. Japan has struggled with growth and inflation since the 1990s, so Japan's central bank has adopted loose monetary policy measures, including the introduction of negative interest rates. From this chart, you can see that Japan's interest rate has been falling to 0% before year 2000, maintained at a low rate across the years, and then falling into negative territory from year 2016 onwards. By having a negative interest rate also means that borrowers gets compensated with interest for borrowing the currency instead of paying interest. Therefore, in good times, yen is often shorted against high-yielding assets. In other words, people borrow money in the form of yen to buy high-yielding assets such as stocks, higher-yielding bonds like corporate bonds, or even another currency that generates a higher interest. Such trades are known as positive carry trades. Take for example an investor John borrows yen and receives 0.1% interest on the amount of yen he borrowed. Given current interest rate is negative 0.1% for yen, he then converts his yen into US dollars at prevailing FX. For illustration purpose, let's assume he can put his US dollars into a fixed deposit account and receive a 2% interest. By simply doing so, he would have generated a 2.1% positive carry trade. Now, the astute mind of yours must be thinking, there's definitely a catch here because there's no free lunch in this world. That would actually be right or wrong. For our explanation, let's do away with any fees or commissions involved in executing the trades and just focus on trade economics. As US dollar is yielding 2% interest and together with yen's negative 0.1% contributing to the 2.1% positive interest carry that we see, based on the concept of interest rate parity, US dollar is supposed to weaken against yen by the same degree, and in this case 2.1%. Therefore, when John converts his principal with interest back to yen to repay his original loan borrowed in yen, he will be subjected to a stronger yen FX, and as a result, break even entirely on his trade. In principle and theory, this is so that nobody could obtain any arbitrage from trading in such a way. However, in reality and in practice, this might not always be the case, as in good times, money is almost always flowing into positive yielding currency, which results in them appreciating. This can be attributed to various reasons, including investors' greed for better yield returns, or behavioral biases like herding effects, or many other factors and components affecting a currency strength, which we will leave that to another video. To continue on John's story, if he were to use his US dollars proceeds to buy an equity ETF and generate 10% capital gain, that would produce a yield accretion to his portfolio. Of course, he will still be subjected to risk of the equity ETF he bought, as well as the FX exposure risk we mentioned earlier, but in general, such carry trades could potentially provide additional yield to his portfolio. Now, this might all be rosy in good times, but in times of crisis, investors scramble to unwind this carry position. John is feeling jittery and no longer wants to hold onto his equity ETF. In fact, after he sells his equity ETF, he wants to quickly convert the US dollars proceeds back to yen to meet his loan liability denominated in yen. Now imagine this happening to many investors who have done the same carry trades and are panic selling their risky assets while buying back the opposite leg of their carry trades. As yen is popularly used for such carry trades, during these unwinding scenarios, yen gets bought back massively, resulting in the strengthening of yen during crisis scenario. This strengthens yen position as a safe haven. The second reason that can explain this is Japan being the largest creditor nation in the world. Based on Reuters report in 2019, Japan's net external assets grew to their second largest amount on record last year, making it the top creditor nation for the 28th straight year. The net value of assets held by government, businesses, and individuals stood at 3.1 trillion US dollar. Japan's net external assets were about 1.3 times those held by Germany, the world number 2 creditor nation with 2.35 trillion in net asset at the end of last year, followed by China. Further to this, Japan has a large current account surplus. A quick look at this chart shows you that majority of the time over the past 2 decades, Japan has been posting strong current account surplus, reaching 3 trillion yen in 2020. The large current account surplus was sustained by strong exports of automobiles and electronics in its early years, but in the later years contributed by interest and dividends coming from direct investments in foreign production. This reinforces its standing as the world number 1 creditor nation. This is particularly important during periods of risk aversion, as investors will typically move their assets back home in order to ride out global market volatility. In this case, Japan companies and investors repatriate their assets home by selling foreign assets and converting the proceeds into yen to purchase domestic assets. The resultant inflow of yen during such uncertain times causes yen to strengthen and thus reinforces its status as safe haven. The third reason that can explain this is simply behavioral influences such as herding effect and self-fulfilling prophecy. Due to historical correlation and movement, investors have become familiar with yen's status as safe haven, and therefore it becomes a self-fulfilling prophecy. Likewise, investors know that other investors view yen as a safe haven and therefore also treat it as such. Following such a pattern, the yen will see inflows during uncertainties even though investors themselves might be unsure exactly why. Such a behavior strengthens its status as safe haven too. The fourth reason that can explain this is that Japan is still the third largest economy in the world, and their position is only after US and China despite it struggling for growth for the past decade. Correspondingly, the yen is still the world's third most traded currency, comprising around 16.8% of total daily trades. And Japan's capital market also boasts a liquid and robust reputation owing to Japanese government's success in building a market renowned for its transparency, integrity, and stability. All this coupled with some of the points mentioned earlier like a strong net foreign asset position and a strong current account surplus only mean one thing. Japan is still a financial powerhouse. Furthermore, the low interest rate environment adopted by perpetual loose monetary policy also makes yen a suitable investment for investors who become more risk averse in times of uncertainty. This also helped to reinforce yen's status as a safe haven. What other reasons do you think could explain why yen remains a safe haven even when Japan's economy has been deteriorating for the past decades? Please share with us your views in the comment section. If you enjoyed the video, please don't forget to like and subscribe to our channel. If you have not checked out our previous video on why does US dollars remain so strong even after Fed prints trillions of dollars, please click on it now and watch it. At this point, we would just like to quickly introduce ourselves. We are a newly started channel to explore the many whys we have in our minds. Humans are deeply curious in nature and are constantly asking why. Therefore, we hope that you can share with us your many why questions in your mind in the comment section so that we can try our best to answer them through our video content. We are only just getting started and hope that you can support and help us grow. Your support will mean the world to us and we tremendously appreciate it. Thank you.